I get the question a lot. Hey, Truman, can I and how does a 401k or retirement plan in general work if I'm a contractor, right? And most of the time they've been at some W-2 job, like they've been at Kaiser for so many years that they've never had to worry about it. It's just been kind of set up for them or whatever. And they're worried like, hey, can I still do the same amounts? So just wanted to take this time and tell you that absolutely you can set up your own plan. If you're an S-Corp, especially, you can set up very easily a solo 401k plan, meaning you're kind of the only one participating in that plan. And the mechanics of it sometimes get kind of confusing. However, I think with this visual, we can walk through really how it works. So I think the easiest way is to realize there's kind of two different hats. When you have an S-Corp, you're both the employer and the employee. And so from the employee side, say, and it's all going to be based off of when you're an S-Corp, you have to pay yourself a reasonable wage. So whatever amount that works out to be, and you've calculated that out. So in this example, the reasonable wage is say $150,000 that you're paying yourself from your contract proceeds from that corporate bank account already. You've set that up, $150,000 of wages. Based on that, you can do, depending on your age, say it changes every year, but say $23,000 you can do just as if you were, at a different employer, working for Kaiser or whatever. That's the employee portion. Okay. So that amount though, if you have a year where maybe you've already maxed out your employee contribution at Kaiser, that means that's now exhausted. You can't do that for your S-Corp. So that amount, the employee amount, has to be looked at across all employers, across all quote unquote jobs. Okay. So in this example, this CRNA cannot do the employee amount. However, even if they have maxed out their employee contribution at another employer, or say they are a full contractor and they've now maxed out that amount, $23,000 or whatever the amount is for the year, for the year that they're in, that means that they still can do an employer amount. Okay, so these are two different amounts with different ways that we get the money in the account. So the deadline to do the employee one is December 31st of the year. Okay. So a lot of my clients will set up maybe a monthly amount or a quarterly amount that they contribute to their 401k on the employee side to time it out so they hit that maximum. Some of them just do it in December. They cut, a large check and they do it all in, basically a catch-up amount at the very end of the year. So you have to do that before December. The employer side is a different calculation and it's a different, maximum altogether with a different deadline. You can do it after the year has ended. And I love it because I can work with my clients, figure out their tax bill, figure out kind of what their cash, need is for taxes. And then they can say, okay, well, yeah, let's do, the maximum, which is 25% of whatever your W-2 shows for that year. And we can do that before we file your tax return. We can, figure out what amount between 0 and the maximum that you want to do on the employer side. Now, when it comes to the logistics of it, so as an S-Corp owner, you are the owner, but you're also the employee. The employee gets paid through a payroll check, once a month, say. And so if you want to pay yourself, contribute, $1,500 a month into your 401k, then you'll set it up through your payroll service as a pre-tax deduction. And so when you hit, pay the paycheck, when you hit that button and it pays the payroll amount, it's going to not pay that $1,500 deduction. It's a deferral. That's your job as the employer to take that money. And now the paper trail shows $1,500 being contributed to the 401k. So you as the employer take the money from the corporate bank account and send it to the 401k account. So now the paper trail matches the cash that you've contributed for that paycheck or that period or whatever it is. And so on the books, we have it recorded correctly on the W-2. Basically, at the end of the year, it shows, the total that you've contributed to the 401k, and it's, all factored in and calculated correctly on the W-2. And then the cash itself has been now transferred by you, the employer, from the corporate bank account to whatever account you have set up at Fidelity or Schwab or whatever it is. Okay. So that's how it kind of, the mechanics of it work. And if you combine the 23,000, or there's even more, if you're over a certain age, you get a catch-up amount, plus the employer, we call it the profit share portion, the 25% of your wage number, you can get, well over $50,000 into that account, which is typically a lot more than you could if you're working just at Kaiser. Okay. So, and that's attractive, because if you go all in on the contract side, yes, you leave the pension or whatever, the match in the 401k, at least on the Kaiser side, you're not getting matched by some third party. However, if you make enough more on the hourly side as a contractor, then you can just fund that difference yourself. You can match that. You can create your own match, and you still come out ahead if your hourly on the contract side is high enough, which is awesome. So that's kind of how a 401k works as a contractor. You can do oftentimes a lot more. You get more flexibility of your options. And if your hourly supports it, you actually can come out a lot better in a lot of ways. And so that's the dynamics of how it kind of works mechanically on the payroll side. And that's what my clients are doing in order to still save for retirement, to put away, to set up that retirement account, and it saves them tons in taxes. Also, it saves them, usually my clients as CRNAs, high tax brackets. And so whatever amount you defer, you don't have to pay that income tax on, which is fantastic. I always tell them it's like moving money from one pocket to the other. That money is still yours, it's just in a different pocket. Yes, it has some rules of, when you can access that without having a little penalty, but it's still an amazing option. And I've addressed this also in the past. There's definitely like a way that you can manage your total income as a taxpayer, which you might be right on the border of being able to get this deduction called a qualified business income deduction. Now, that's a 20% deduction on your income as an S-Corp owner. But if you have too much income, it phases out and it goes away. And sometimes this 401k contribution calculation can lower your taxable income down to the amount that this QBI deduction is now fully allowed, or at least partially allowed. So it's like a benefit on top of a benefit. So that's another thing to consider. You want to make sure that you're maximizing that element of your 401k, that it's not, you don't always just have to look at the income tax savings, but there's also, other deductions that sometimes ride on top of your total income as a CRNA. And you want to be able to maximize and balance that out and be like, oh, if I do an extra, X amount into my 401k, that then unlocks more deduction that I would have, not qualified for. So it's a way to kind of correctly manipulate your income levels to get more deduction and optimize your tax situation.